In recent years, a notable shift has emerged within the European Union as several member states contemplate adopting citizenship-based taxation, a system where citizens are taxed on their worldwide income regardless of their residence. This approach contrasts with the more prevalent residence-based taxation, where tax obligations are determined by an individual's place of residence. The United States is currently the only developed nation that fully implements citizenship-based taxation, taxing its citizens on global income irrespective of their location. France has taken significant steps toward implementing CBT. In October 2024, the French Finance Committee adopted an amendment to establish a targeted universal tax, requiring French citizens residing in countries with lower tax rates to continue paying taxes to France. This proposal mandates that French nationals who lived in France for at least 3 years within the decade before relocating must pay taxes equivalent to their hypothetical French tax burden. To prevent double taxation, the amendment outlines a tax credit mechanism, allowing these citizens to receive a credit matching any taxes already paid in their country of residence. The scope extends beyond income tax to include inheritance tax, capital gains, and dividends. Lucie Castex, the left-wing candidate for the role of Prime Minister, has endorsed this fiscal reform. She advocates for a major tax overhaul, including proposals for French citizens living abroad to pay taxes to the French authorities, similar to the American system. This initiative aims to address international tax competition and prevent tax burden shifts to the working and middle classes. The Netherlands is also exploring options to tax its citizens on their worldwide income. While specific legislative proposals have yet to be formalized, discussions indicate a growing interest in aligning with the CBT model. This consideration reflects a broader trend among EU countries reassessing their tax policies in response to globalization and the mobility of high-net-worth individuals. The potential shift toward CBT within the EU carries significant implications for citizens residing abroad. Under CBT, individuals would be obligated to report and pay taxes on their global income to their country of citizenship, regardless of their residence. This could lead to increased administrative burdens and potential double taxation, despite mechanisms like tax credits designed to mitigate such issues. Implementing CBT presents several challenges. Administrative complexity. Tax authorities would need to establish systems to track and assess the global income of citizens residing abroad, requiring substantial resources and international cooperation. Double taxation risks. Despite tax credit mechanisms, there remains a risk of double taxation, particularly in countries without comprehensive tax treaties. Impact on mobility. CBT could discourage citizens from working or residing abroad due to increased tax obligations, potentially affecting labor mobility and international business operations. The concept of citizenship-based taxation, CBT, has traditionally been rare worldwide, with only a few countries like the United States and Eritrea implementing it in a full form. The U.S. taxes its citizens on their global income regardless of where they reside, creating a robust compliance and reporting structure that reaches across borders. However, this approach is the exception rather than the rule globally, as most nations, including nearly all in Europe, apply residence-based taxation, which taxes individuals based on where they live rather than their citizenship. The recent interest among some EU countries, such as France and the Netherlands, in implementing CBT signals a significant shift in global tax policy. This interest has grown as governments seek to address a few specific challenges. Countering tax evasion. With globalization and the ease of relocating assets, Individuals and businesses can often reduce their tax burdens by moving to low-tax jurisdictions. Citizenship-based taxation is seen as a way to mitigate such tax avoidance. Retaining revenue from wealthy citizens. Many high-net-worth individuals, HNWIs, and ultra-high-net-worth individuals, UHNWIs, have been relocating to countries with favorable tax environments. The United Arab Emirates, UAE, in particular, has become a top destination due to its absence of personal income tax, strategic location, and business-friendly policies. Countries like Portugal and Cyprus, with their own golden visa programs, have also attracted HNWIs, offering tax residency incentives in exchange for investment. Shifting tax burdens. As wealthier citizens leave, countries risk losing revenue, potentially placing a larger tax burden on remaining residents. Citizenship-based taxation is viewed by some policymakers as a measure to ensure that citizens continue contributing to the country's finances, even if they choose to live abroad. The consideration of citizenship-based taxation by EU countries like France and the Netherlands signifies a pivotal shift in tax policy, aiming to address issues of tax equity and revenue generation in an increasingly globalized world. While the implementation of CBT could enhance tax fairness and prevent tax avoidance, it also introduces complexities and challenges that require careful consideration. As these discussions progress, it is essential for policymakers to balance the objectives of tax equity with the practical implications for citizens and the broader economy.